How to get in on AI the sneaky way. Welcome to Market Insight. I'm David Pollard. Nvidia shares saw more gains as markets returned from a holiday weekend today, that after already closing at a new record high on Friday. A 10-to-1 stock split announced by the chipmaker after its stellar results last week could well lure even more retail investors and spark further massive surges in its share price. Well, to discuss that and how investors can play the current mania for AI, I'm joined by Brian Crowers, President and Portfolio Manager at Scharf Investments. Brian, many thanks for joining us. Nvidia adds fuel to the discussion around US tech's dominant position on the US benchmarks and, of course, its sky-high valuations, which you, for one, see as rather over the top and reminiscent of the internet bubble of 25 years ago. Tell us more about that.
Yeah, thanks for having me. I mean, obviously, the NVIDIA report was very strong, and we think that'll continue for some time. I mean, it's an arms race for people to get these chips. However, we would warn investors that the valuations are already reflecting this. You've got NVIDIA itself at well over 40 times next year's earnings, and that's on expecting very massive growth for next year. And the tech sector itself is now trading at well over 30 times earnings. Interesting enough, if you looked at the tech sector performance versus the S&P 500, it's above where it was at the peak of the last bubble. And tech as a percentage of the S&P 500 is now also above where it was at the peak of the bubble. In fact, if you add tech and what we call tech-like, because names like Google and Amazon and Tesla are not included in the tech sector, it's well over 40% of the total S&P. So the S&P is now becoming very much a tech-heavy index as those valuations are really heavy. Now, a lot of investors might think, oh, well, of course, that's the wave of the future, AI, and I want to get in. The problem is, if you look at 1999 and you invested in all the top tech names, even though the internet surpassed everyone's expectations, you would have suffered as an investor a very long period of underperformance. And so we think it's better for investors to look outside of those names that everyone's crowding into.
Well, even with that warning in mind, Nvidia, for example, has 52 out of 57 brokerages recommending it as a buy or higher. So can investors afford to miss out on the AI play? And if not, how should they go into this top-heavy and very volatile space? What should their approach be?
Well, we think there's a lot of kind of sneaky ways to play it. One name a lot of investors don't really think about is Samsung. It's one of the largest tech companies in the world by revenue, and they're really benefiting from demand for memory. And so we think they're gonna participate in this over time as well. And yet they're trading at 12 times earnings, just over book value. In fact, 30% of their valuation is in cash relative to their book value. But yet we think demand for AI servers is going to grow 30 to 35% over the next 5 years, and we think Samsung is going to be a beneficiary of that trend. Another way is Oracle. Oracle is also investing a lot into the cloud and AI, and yet that stock's trading somewhere around 20 times earnings. Their cloud revenue growth was up 26% in the most recent quarter. They have a strong backlog, and we really think that their growth is going to be accelerating despite the fact that they're trading around an S&P 500 multiple.
Let's move on. Best Buy, Nordstrom, Costco, Dollar General, those are just some of the big retail names reporting their latest earnings this week. What's your take on the sector, and how strong is the US consumer?
Well, the consumer came into the last couple of years with huge amount of savings from COVID. The government really gave out a lot of cash to people, and basically they were sitting on record savings. That cash has been burned down, and so what you're seeing from a number of retailers that have already announced is a little bit of a trade down and a little bit of stress from some consumers. So some things are really strong, like travel, for example. Booking had very strong bookings growth, and travel seems to be really strong. Walmart had strong earnings, but they cited the fact that grocery was one of their big areas, and the difference between at-home food and restaurant now, because of service costs, is wider than it's ever been. So you're starting to see trade down to grocery, and the high end is still doing well. Whereas something like a Target or a Home Depot or Lowe's has really struggled. So, some of the ones coming up, we would expect Costco to do well because of their food, but some of the other, home-oriented ones or kind of more discretionary stuff are probably going to be a little more challenged.
And finally, Brian, in your notes, you also speak about the quote, revenge of the average stock. Can you briefly outline your theory there and who you like in that context?
Yeah, so what we mean by the revenge of the average stock is the S&P 500 is a market cap weighted index, and so it's very tech heavy, as I mentioned before. However, if you look at the 500 stocks and you just take the average stock, over historically, the average stock actually outperforms the S&P 500 because smaller companies tend to outperform. Last year, however, that was completely reversed, with the average stock being down 13.3% more than the S&P. We think that it's similar to in 1999 when the average stock went on to really outperform after that happened. We think it's poised again for something like that to happen. An example of more average stock would be something like a Comcast, which has grown at 14% per year the last 10 years, but is trading at under 10 times earnings. So we think there's a lot of stocks out there that investors are really ignoring, and if you're willing to look outside of tech and outside of the big cap names, you can really find some good values.
Okay, Brian, we'll leave it there. Brian Crowers, President and Portfolio Manager at Scharf Investments. Many, many thanks for sharing your thoughts today. That is your Market Insight. You can watch more videos on Reuters.com.